to stay for as many presentations as you would like. And at this point, I'm going to turn it over to Kyle, who's going to be presenting on hedge fund investing.
I'm Kyle Richard, and I did my Capstone project on hedge fund investing. Some complications and problems that came along with my project was I was not able to track personal investments because I didn't actually put money into the market. The stock market went down dramatically while this project was going on. I wasn't able to go into firms because of COVID-19, so I couldn't see how trades were executed, couldn't see how they track securities, and couldn't see the software that they use to do those things. Also, a lot of the terms were new and foreign to me, so I had to ask my mentor a lot to explain them to me to gain an understanding of them. Why I chose hedge fund investing. My future job, I want to be a hedge fund trader, so having some background knowledge on what I want to do later in life is fairly important. Also, this serves as background knowledge for some college courses that I will be taking in the future. My dad is a financial advisor, so he works in the financial field. And investing in hedge funds is one of the most unique and interesting ways to invest your money. A change in topic. At first, I was going to do investing strategies at different times in a person's life, such as young, middle-aged, and old. But hedge funds came as more of an interest to me, so I just stuck with that. What research I did? I listened to several podcasts with Peter Lynch, who is known as the father of hedge funds. I used what was said in those podcasts to ask questions to my mentor and have him explain certain aspects of them to me. I researched everything about hedge funds through websites and online articles. I talked with my mentor often about how and why certain sectors of the market were going up or down. I also tracked the stock market on my own to gain an understanding of why it goes up or down. Why this was meaningful. My job goal is to become a hedge fund trader again. Gaining a large understanding from the research will help a lot later in life. It is important to understand how to invest and where to invest your money. And it's a good way to learn from my dad about the financial world. What I learned during this project, I learned the basics of the financial markets, the different strategies implemented in different hedge funds, how hedge funds differ from other investment firms, requirements to invest with hedge funds, tax benefits of hedge funds compared to other investment firms, the types of people that should invest with hedge funds, why people should invest with hedge funds, and how people react with their money to a pandemic. How this project will benefit me. It will help me with investing money later in life, knowing where to put it and how much to put in. It also will help me have the ability to have an educated conversation with someone that is in the financial field. I'll know where to put money at different stages in my life. I'll know the tax benefits that come along with hedge funds and the taxes that go along with regular investment firms and how they work. Later in life, knowing how much money to allocate to riskier investments. What I would do differently next time. It would require more time and money, but I would invest with an investment firm and then invest with a hedge fund and compare the overall profits to see which one outperformed the other. This would have been especially interesting to do during this time because of the pandemic and the market downfall. The questions that fueled my research. What are hedge funds? What are the types of hedge fund strategies? What are the requirements to invest in hedge funds? How do hedge funds work? Why should people invest with hedge funds? Who and who should not invest in hedge funds? What are hedge funds? They are actively managed funds that allow for long and short-term investment positions. Actively managed funds are funds that offer the ability to outperform the index or the market as a whole. Hedge funds will invest more aggressively in a wide variety of financial products compared to other investment firms. Hedge funds use conjoint funds and use abstract strategies to earn returns for their clients. They're also not regulated by the SEC, which means they can't market themselves to the general public. That's why you'll never see an ad for a hedge fund company. And they can't take money from the general public. So you have to have a certain net worth or be an accredited investor. The types of hedge fund strategies: long and short equity funds, market neutral funds, merger arbitrage firms, convertible arbitrage, event driven, global macro, and short only. Long and short equity strategy. The first hedge fund used this strategy. Most hedge funds today still use this. It reduces the market risks because a portfolio is set up to go long and sell short on two competing companies based on their evaluations. So you can make almost double the amount of money, or it will hedge your money. And here's a graph showing how the long and shorts outperform the S&P 500. The S&P 500 is the blue line, and the Accredited Suisse Long and Short Equity Index is the dotted orange line. And as you can see, it usually outperforms all the time, and especially during the dips. As you can see, between August 15th and October 15th, you can see that big dip by the S&P 500, and the long and short equity index doesn't take that big of a dip. Market neutral strategies. Market neutral funds try to have a little to no market exposure. So long and shorts will have the same, if not very close market value. They rely heavily on stock selections, and return on investments are usually these type of funds will use leverage a lot of the time. But in this graph, you can see that they are the market neutral indexes, the ones that are the dark blue. They're much lower than the other ones, but it has much less risk to it. So. Merger arbitrage firms. These are event-driven strategies, pretty much. It gets its returns mostly from merger activity or from a share exchange transaction. A share exchange transaction is one in which a corporation's shares are exchanged for those of another corporation, but they remain two separate companies. This is just a riskier version of market neutral almost. And then here's another graph showing how it outperforms the others. Convertible arbitrage firms. They combine straight bonds with equity options. They try to have bond and stock prices offset each other to maintain a neutral position. Volatility in this is very, very important. Event-driven firms. They make the most of pricing inefficiencies that occur before and after an important business event. They take advantage of the mispricing of stocks. And then some examples of the events that they look out for are bankruptcy, new items hitting market, acquisitions, and mergers. Patience and risk management are keys in these firms. Global macro firms. They focus on futures due to liquidity. They analyze how macroeconomic trends will change certain rates, and the return on investments are the most volatile in this strategy. But as you can see from this graph, the global macro firm is the red line, and it's outperforming the composite index by a good amount. And especially with this dip at the end here, as you can see, it doesn't take that dip. So short only firms, they try and find overvalued stocks and sell them at a high price and then buy it back at a lower one to make money. These do well in bear markets when the market's going down. They'll talk to suppliers and competitors to see if there's any trouble in the future for one of the companies. But they must overcome the upward trend of the financial markets. The financial markets, on average, go up to from 5 to 10% each year. So it's tough to be a short-only firm and you have to really rely on stock selection. Quantitative firms. This strategy utilizes quantitative analysis to make investment decisions. They use a number of models and measurements. They use computer algorithms to pull the trigger on decisions such as trades and when to buy, when to sell. The internal workings of the strategy are very obscure and unlike any other because they use computers instead of humans to do all these things. The requirements to invest with hedge funds. All hedge funds will charge a management or a performance fee, sometimes both. And a lot of the time it's a 2 and 20 strategy. So they take 2% of your initial investment, and then the performance fee is 20% of whatever profits that they make. Hedge funds will require you to be a qualified client, or you'll have to invest a high minimum value. Sometimes the minimum value will be around $1 million. They can be as low as $250,000 and as high as $25, $50 million. To invest with some of the lower ones, you must have an annual income of $200,000 or $300,000 if you're married. There are a limited amount of people that can that a hedge fund can take in. That's why they have these minimum requirements for investments, and they tend to accept the wealthier people that can withstand pretty large losses. Advantages offered by hedge funds. Long and short, they can sell long and short on securities. For stocks that they want to, in the long term, they will try to find stocks that are undervalued, and in theory, they'll begin to rise. For stocks that they want to short, they'll find stocks that are overvalued, and in theory, they will fall. They use a wide range of strategies, from traditional strategies to ones that are more specialized, such as the quantitative analysis one with the computers. They invest in a variety of asset classes, which are groups of financial instruments that have similar financial characteristics. They also have unique tax filing requirements, and they use leverage in many of their investments. Some of the tax breaks that come along with hedge funds are that they use capital interest. So this allows profits to be taxed as capital gains instead of regular income. This means that it gets taxed at a maximum of 20%. Income tax for people that can invest in hedge funds is about 35%. So their returns, they'll be saving about 15% on their profits from investments. Also, a lot of them use a mark-to-market basis, which means that managers and investors can recognize trading gains and losses as income or loss and not capital. This means that they can offset their gains with losses from prior years, so they can pay less in taxes. The use of leverage in hedge funds are very important. The first step in hedge funds using leverage is to borrow money from other large investment banks. Prime brokers provide capital to hedge funds. This allows for hedge funds to take leverage long positions or leverage short positions in securities. And as long as they outperform the borrowing costs, the return on investment will be enhanced greatly. It will magnify low risk returns as well. So leverage will be used on securities that really wouldn't be worthwhile unless the returns were largely magnified, coming at a low risk of losing money. So a lot of the time, hedge funds and firms can borrow up to 6 times the amount of money that you invest. So if you were to invest $100,000, they can take $100,000 from 6 other firms, and they can make it so that your investment is $600,000. So you make 6 times the return on investment that you would have made if you just did a regular investment. But you can lose a lot of money if you do it that way too. Sorry, I don't know why my computer is being like this. Why to invest with hedge funds? They produce uncorrelated returns to fixed income markets. Uncorrelated returns are those in which give returns 3 to 5% higher than the traditional markets. They provide large portfolio diversification. Hedge funds tend to put investors in long and short sell situations, which is important in diversification. They use aggressive investment strategies, such as the use of leverage to their advantage, up to 6 times the initial investment. Hedge funds are known to outperform other investment firms in bear markets. So who should invest in hedge funds? People with a high net worth, people that are seeking high risk investments, and people that can afford to lose money mentally as well, because that's a very large part. How people reacted during the pandemic. People were scared and wanted to pull their money out of the market. No one wanted to be buying stocks because they didn't know when the market was going to stop going down. So in a way, they were panic selling and getting. They might have been taking losses on a lot of their stocks, but they didn't trust the market, so they wanted to get rid of all their. They wanted to make it liquid. How people should have reacted during a pandemic. They should have held their positions in stocks. If you have money that is not already invested, you should be buying more stocks because the market's at a low price. When the market hits lows, you buy more stocks, and because through all the dips in the market throughout history, the market still averages 8 to 10% every year. So you're making 8 to 10% if you stay in the market every year. And that's it. Thank you very much.
Nice job, Kyle.
Thank you.
So tell us kind of what inspired you to learn more about hedge funds.
Well, my dad would talk about it a lot when he would come home from work and stuff. And it just came as a big interest to me just because of the many different strategies that they use to invest and how risky it is.
Yeah, it definitely is the case. So if you were to invest in a hedge fund, what would be 3 things that you would do to make sure that you would be successful?
I kind of like the short only strategies because if you can do the research well on certain stocks, you can find out that they have either their market value is way too high, and then people will realize that and it'll slowly go down.
Mm-hmm.
I mean, research is just a big key with that. I'd make sure that I'm talking to the right people with it,
Mm-hmm.
and I allocate my money in certain ways so that it'll hedge my losses if I lose a lot.
Sounds like a good plan to me. All right, so I'm gonna see if we have any comments or questions from the audience. For those of you tuning in, you could use the chat feature at the bottom of your screen. And we have one here from Mr. Maseni. Nice job, Kyle. It was interesting to hear the thought on investments versus what's happening in our economy today.
Yeah.
Yeah, I definitely agree on that. I know a lot of people have been concerned about their 401ks, and I can't imagine having a hedge fund and concerns with that with the pandemic. Hopeful that things are getting better. Do you think so? Do you think it's getting better in terms of investments and such?
I think it's getting better for a short period of time, but I feel like if there is another breakout of it, it could be extremely bad for the market and people's investments.
Yeah, it's scary. Really scary. So I know you're a senior. So what are next steps for you in terms of this focus? Do you have a career interest in this at all, in finance and business?
Yeah, I'm going to be majoring in business finance, and then I plan on getting my MBA in graduate school, and then hopefully I can work for a hedge fund someday.
Awesome. Well, it sounds like you had kind of a good start to that through this Capstone project. I really hope that you continue to learn more about it, and I hope that it was helpful for you in your beginning steps of post-secondary planning.
Yeah, it was.
All right. So I am going to bring